Hi, I'm Philip Smith, financial planner with Tidepool Wealth Strategies, helping self-employed professionals and solopreneurs just like you cultivate resilience in your plans to retire well. This is the Financial Planning Podcast about money management, best practices for long-term growth, wealth-building truths and fallacies, successful retirement strategies, and more, where I'll be sharing concise, actionable retirement planning guidance. Welcome to the Financial Flow. Hi everyone, welcome to episode 8. I'm Philip, and today we're diving into the tide pool to protect our financial ecosystem from being polluted by some trending tax advice on TikTok, and discussing why you should think twice before following it. In a previous episode, I mentioned how as an enlisted Marine, I didn't even know the term cash flow. Paychecks automatically happen on the 1st and the 15th of the month. The only thing I knew for sure was how to spend it. As a result, my financial strategy back then was a total disaster. Now let's ensure you avoid similar pitfalls with tax advice. In case you want to check my work or research this topic on your own, the sources referenced here are the Financial Planning Association via their news articles, Accounting Today, and the IRS via their irs.gov site. And if you find this episode helpful, feel free to share it and subscribe to the channel. Now let's wade into it. Myth number 1, writing off lifestyle expenses. The first myth is the idea that you can write off quote-unquote lifestyle expenses. In other words, personal care expenses like clothing, home decor, or makeup used for your virtual meetings and influencer videos. Some influencers suggest that if you brand your personal items with your business name, you can claim them as a business expense. This is about as true as me saying I can write off my morning coffee because it keeps me awake during my client meeting prep. The IRS has very specific guidelines about what qualifies as a legitimate business expense. According to the IRS, items must be ordinary and necessary for the operation of your business. Simply labeling personal items as business expenses doesn't cut it. Most of these attempts can lead to deductions being denied and even the possibility of triggering an audit. Now, unless your cat is your business partner and you're writing off his grooming expenses, don't try to get too creative with these deductions. There are real-life consequences when acting on advice. When it comes to writing off personal care expenses, influencers claiming these personal care expenses as business deductions have faced IRS audits and penalties. The IRS rules are clear that these expenses, providing personal benefits, aren't deductible. You can find this info right there on their website, irs.gov. Just a quick sidebar before we move on. I can't emphasize enough the importance of keeping your business and personal finances separate. If you're operating as an LLC or an S Corp, it's critical to have distinct accounts for legal and tax reasons. Mixing finances can lead to that term, piercing the corporate veil, where you lose the liability protection an LLC or corporation provides. Plus, come tax time, separating expenses ensures you're not accidentally claiming personal expenses as business deductions, which could get you flagged for an audit. Myth number 2. Claiming home office deductions for personal spaces is okay. Yes, the home office deduction myth. It's not really a myth, but it is something you need to do correctly. It's really more of just incorrect information than myth. TikTok videos might have you believe that simply calling any room in your house an office qualifies you for a deduction when you file your taxes. Wrong again. The IRS requires that the space is used exclusively and regularly for business. Emphasis on exclusively and regularly. Using it for personal stuff can disqualify you and lead to penalties. There have been cases where people face significant fines for misclassifying personal spaces as home offices. Sorry, but if your home office doubles as your yoga studio, guest bedroom, and kids' playroom, the IRS is not going to be impressed. Some TikTok users have faced fines after trying to deduct personal spaces as home offices without exclusive business use. This misuse has led to the IRS's increased scrutiny and penalties. Myth number 3, starting an LLC for write-offs. While taking in the TikTok teachings, you may have heard that you must start an LLC in order to claim write-offs. Some TikTok advice givers suggest that forming an LLC is essential for claiming business deductions. However, as a sole proprietor, you can claim many of the same deductions without the complexity and costs associated with forming an LLC. The IRS allows sole proprietors to deduct ordinary and necessary expenses related to their business. Forming an LLC might be beneficial for some, especially for liability protection, but it can also introduce unnecessary complications, particularly if your business is small and your income is modest. This myth can mislead people into making costly and unnecessary decisions. Again, there are very real consequences here as well. Individuals who formed LLCs based on TikTok advice, thinking it was necessary for write-offs, have dealt with complex tax issues and administrative burdens which were completely avoidable. Now, our final myth for today, myth number 4, using C corporations for small businesses. The last myth I'll touch on is the idea that incorporating as a C Corp is a smart move because it, quote unquote, looks professional. This advice is like suggesting you should wear a tuxedo to a backyard barbecue because it looks classy. C Corps are subject to double taxation, once at the corporate level and again on dividends. This structure is often unsuitable for small businesses and can create significant tax burdens and administrative complexities. For most solopreneurs, if anything beyond being a sole proprietor is needed at all, a simpler structure like an LLC or an S Corp is usually more appropriate. Okay, so we've covered 4 big myths, which aren't necessarily myths, but are actually the misapplication, dare I say the abuse, of real business deductions that exist. We've also covered how business structure, while important, doesn't always have to progress beyond sole proprietorship. The long and short of it is this. Influencers want to reach as many people as possible. The information they share doesn't help and isn't intended for every single person that it reaches. And from what I've seen and heard, most of the people sharing this information aren't even professionals in these highly regulated and financially impactful fields of expertise. So let's take some action on this. First and foremost, if you've run across these ideas or others, verify before you trust. Always cross-check any tax advice you come across on social media with a trusted financial advisor, a tax professional, a business attorney, and/or the IRS website. Secondly, separate your personal and business expenses. Maintain clear records, and when it comes to the business side of your taxes, only claim deductions for expenses that are exclusively business-related. I'm not a CPA, so don't just take my word for it. Connect with a tax pro who can give you guidance on doing this right. Third, which I say constantly, consult a professional. Before making any significant decision on business deductions, ask a tax professional. Before making changes to your business based on social media advice, consult with a tax professional and check in with a business attorney to understand the potential implications. Thanks for tuning in to this episode of The Financial Flow, brought to you by Tidepool Wealth Strategies. Until next time, stay resilient and plan to retire well. It's disclosure time. This podcast is intended for educational purposes only, should not be used for any other purpose. The views depicted in this material should not be considered specific advice or recommendations for any individual, are not intended to be financial, tax, or legal advice, and do not represent Tidepool Wealth Strategies or Cetera Advisor Networks, LLC. For a comprehensive review of your personal situation, always consult with a financial, tax, or legal advisor. Neither Cetera nor any of its representatives may give legal or tax advice. Our office address is 450 Country Club Road, Suite 350, Eugene, Oregon 97401. Securities and advisory services are offered through Cetera Advisor Networks, LLC, a broker-dealer, registered investment advisor, and member of FINRA and SIPC. Cetera is under separate ownership for any other named entity. Whew.